Welcome in, everyone. Ready to dive into a true classic. We're talking The Intelligent Investor today.
Ah, Benjamin Graham's masterpiece. A must-read for, well, anyone who wants to invest wisely.
Exactly. And don't worry, you don't need to be a Wall Street whiz to get something out of this deep dive. We're going straight to the core. Those timeless principles that anyone can use, no matter if you're a seasoned pro or just starting out.
That's what's so great about Graham, he gets it, that it's not just about the numbers.
Right. He talks about being an intelligent investor, but he's not talking about, like, IQ.
Nope, not at all. It's all about temperament. Having the discipline, the patience, keeping those emotions in check, that's key.
It's more about mindset than anything else, wouldn't you say?
Absolutely. It's like mental fortitude, not just financial knowledge.
And that really resonates, I think, with a lot of our listeners, people who'd rather do their research, take their time, not jump into things blindly.
And speaking of jumping into things, that's where Graham's warnings about speculation come in. Those get-rich-quick schemes, Wall Street just eats that stuff up.
Oh, tell me about it. The dot-com bubble.
Mm-hmm.
I was there watching it all unfold. Companies like, what was it, pets.com? Everyone thought they'd be the next Amazon.
Ah, yes, the allure of the next big thing. It rarely ends well for most investors.
Exactly. So how do we avoid falling into that trap? If speculation is out, what's our secret weapon?
Graham calls it the margin of safety. It's all about having that buffer.
Okay, I like the sound of that. Break that down for me. What does that actually mean?
So even if you've done all your research, you can't predict everything, right? The market has a mind of its own sometimes, so you need that cushion.
Like a safety net for your investments.
Precisely. Think of it like buying a used car. You wouldn't just hand over the cash without getting it checked out by a mechanic first, right?
Of course not.
That margin of safety, it's like that mechanic's inspection, but for your investments, making sure you're getting a good deal.
Okay, that's a fantastic analogy. So how do we find that deal, that margin of safety in the stock market?
Well, Graham's all about finding those undervalued gems. Stocks that are trading for way less than their intrinsic value, what they're really worth.
So that's like buying a dollar for 50 cents, but with companies instead.
Exactly. It takes patience, it takes research, and it takes tuning out all that hype.
Sounds like something our listeners can get behind. They value that long-term approach.
And speaking of a long-term approach, that's where dollar cost averaging comes in.
A classic. I was hoping we'd get to that one today. Such a simple but powerful strategy.
You said it. Invest a little bit at a time, consistently, no matter what the market's doing.
Just like setting up automatic transfers for your savings, but for investments.
You got it. It takes the emotion out of it and lets you build wealth gradually over time.
Love it. Now, I know some people might be thinking, okay, that all sounds good, but does it really work?
Oh, it definitely works. In fact, Graham talks about something called super investors.
Oh, yeah, the people who've actually used these principles to crush it in the market.
Exactly. People like Warren Buffett, for example. He was a student of Graham's, and look at what he's achieved.
Hold on, before we get too far. What was it about those investors? What set them apart?
They understood that investing isn't about chasing the latest trend. It's about finding value. They did their research, they weren't afraid to be different, and they ignored all the noise.
They marched to the beat of their own drum, so to speak.
You got it. They didn't just follow the crowd. They carved their own path.
Now that's inspiring.
Hmm.
But I imagine it's also about finding your own style within that framework, right?
You got it. You don't have to be Warren Buffett, but you do have to understand your own risk tolerance, your financial goals, what you're comfortable with, that kind of thing.
So how do we avoid those common pitfalls, those red flags that tell us to steer clear?
One of the biggest ones, excessive debt. If a company's drowning in it, that's a big warning sign.
Makes sense, like seeing a mountain of credit card bills, not a good look.
Exactly. Another thing to watch out for. Overly complicated financial statements.
Ah, trying to hide something, are they?
Maybe, maybe not. But if you can't understand where their money's going, that's a red flag for sure.
It reminds me of that example in the book, the company whose finances were so messy they needed a baby pants and bib explanation.
Oh, yeah, that's a classic.
Mhm.
Point is, transparency is key. If they're being shady, walk away.
I like it. No shady business allowed. So we're on the lookout for those red flags, but what about the good stuff? What should get us excited when we're checking out a company's financials?
Graham's got us covered there, too. He gives us this really practical framework. You got to look at the earnings, right? How much debt they're carrying, the assets, all that good stuff. It's like having X-ray vision for a company's financial health.
I love that. No relying on guesswork. We can get into the nitty-gritty ourselves.
Exactly. And he even gives you the tools to do it, like the earnings coverage test. It helps you figure out if a company can actually pay back its debts.
Okay, now that sounds incredibly useful. I'm always a little wary of companies with too much debt.
Rightfully so. It's like, imagine a company with a ton of debt. It's like they're carrying around this massive weight.
It's like they're trying to run a marathon with a backpack full of rocks.
Uh-huh, exactly. They might still make it, but it's going to be a struggle, and any little bump in the road could really throw them off.
Makes you think about that example in the book with Chrysler.
Oh, you mean how their stock was all over the place, even though the company itself wasn't doing that badly?
Yeah.
It just goes to show the stock market doesn't always make sense in the short term.
That's why we got to zoom out, think long term, and have that margin of safety to protect us from those wild swings.
Couldn't have said it better myself. Graham actually has this whole chapter dedicated to market fluctuations. He compares the market to a voting machine in the short term.
A voting machine.
Yeah, driven by emotions, rumors, all that fickle stuff.
But in the long run,
In the long run, it's a weighing machine. The true value, it always comes out.
love that analogy. It's a good reminder to tune out the noise and focus on the fundamentals.
You know, he even says the intelligent investor would be better off if their stocks had no price listed at all.
Whoa, really?
Yeah, it's about ignoring the day-to-day and sticking to your guns.
That's some serious commitment. Now, I have to ask about the super investors of Graham and Doddsville. That chapter always gets me fired up.
Ah, yes, the legends. The ones who put Graham's ideas into practice and crushed it, might I add.
They're like the rock stars of the investing world.
And they all had different styles, different portfolios, but they all shared that core belief in value investing.
It's real-world proof that this stuff works. So who are we talking about here?
Well, there's Walter Schloss, for one. Incredible returns with a very simple strategy.
I admire that, keeping it simple.
Then you have Tweedy, Brown Inc., consistently beating the market for decades.
Yeah, of course, the legend himself, Warren Buffett.
Can't forget Buffett. But here's the thing. You don't need to become the next Warren Buffett. It's about finding your own way, your own path within this world of value investing.
I like that. So we've talked stocks, but what about bonds? Where do they fit in?
Graham was a big fan of bonds, especially for the more cautious investor.
Bonds, the more reliable, maybe slightly less exciting, older sibling of stocks.
You could say that, but they're crucial for a balanced portfolio, especially when things get rocky.
They're like the anchors, keeping us steady during those market storms.
Exactly.
So we've got our stocks, our bonds, our trusty margin of safety toolkit. What else do we need to navigate this investing landscape, besides a good map?
Well, one of the biggest takeaways from Graham, and it's something I always come back to, is you got to think for yourself.
Now, that's something I can get behind, no blindly following the crowd right now.
Absolutely not. Graham wants us to be skeptical in a good way. Do your research, challenge those assumptions. Don't just take everything at face value.
So no more blindly trusting those hot stock tips or those
Yeah.
guaranteed market predictions.
Exactly. Remember, you're not investing in some ticker symbol. You're investing in real companies. Businesses with products, with services, with a whole story behind them.
It's about understanding that bigger picture, isn't it? You're not just chasing profits, you're becoming a part owner, in a way.
Exactly. And that brings us back to Graham's core message. It's not about timing the market perfectly or finding that one magic stock. It's about having a solid approach.
A strategy you can trust. It's built on value, patience, and that oh-so-important margin of safety.
Right. It's about knowing yourself, too, your risk tolerance, your strengths, your weaknesses. Investing within what Graham calls your circle of competence.
But we don't need to become experts in everything.
Not at all. Stick to what you know. Passionate about tech. Dive into tech companies. Love a good cup of coffee. Maybe the coffee industry is for you.
It's about connecting the dots between your interests and your financial goals.
Exactly. And remember, becoming an intelligent investor, it's a journey, not a sprint. You're learning, adapting, getting a little bit wiser along the way.
I love that. So, as we wrap things up here, what's the one big takeaway you want to leave our listeners with today?
Invest in yourself. That's the most important investment you can make. Learn, grow, be patient, and never, ever stop asking questions.
Wise words. Thank you so much for joining me on this deep dive today. It's been a pleasure.
The pleasure was all mine. Always happy to talk, Graham.
And to everyone listening, until next time, happy investing.